In today's video, we're diving into the top 5 investment strategies for building long-term wealth. Whether you're just starting out or looking to refine your approach, this guide will provide you with the knowledge you need to make smart investment decisions. So, let's get started. Investing can seem overwhelming, but having a solid strategy can make all the difference. A good investment strategy helps you to navigate the complexities of the market and grow your wealth over time. Today, we'll explore 5 of the most effective strategies: value investing, growth investing, dividend investing, real estate investing, and index fund investing. Let's break each one down. First up, we have value investing. This strategy involves finding stocks that are undervalued by the market but have strong fundamentals. Think of it as shopping for bargains. Legendary investors like Warren Buffett have made their fortunes using this method. Value investing requires a keen eye for detail and a lot of research. The goal is to buy stocks at a price lower than their intrinsic value. This is based on the idea that the market often overreacts to good and bad news, causing stock prices to be higher or lower than their true value. Over time, the market will correct itself, and the stock's price will reflect its actual worth, providing significant gains to those who invested early. Let's consider a company, XYZ Incorporated, whose stock is priced at $50. After analyzing its financials, you determine that its intrinsic value is actually $70. By buying the stock at $50, you're getting a good deal. When the market corrects and the stock price rises to its true value, you'll see a substantial return on your investment. Key metrics to look for include the price-to-earnings (PE) ratio, price-to-book (PB) ratio, and dividend yield. The PE ratio compares a company's share price to its earnings per share, giving you an idea of whether the stock is over or undervalued compared to its peers. The PB ratio compares the market value of a company's stock with its book value, which can indicate if the stock is undervalued. Lastly, the dividend yield shows how much a company pays out in dividends each year relative to its stock price, providing an additional income stream. Always remember to do your homework and thoroughly research each company. Websites like Yahoo Finance, Morningstar, and the company's own investor relations page can provide valuable insights and data. Additionally, tools like ValueLine and Guru Focus can help identify undervalued stocks by providing in-depth financial analysis and valuation metrics. Next, we have growth investing. This strategy focuses on companies that are expected to grow at an above-average rate compared to others. These are typically young, innovative companies in sectors like technology or healthcare. Growth investing is about potential. These companies might not be making huge profits now, but they're expected to in the future. They reinvest their earnings to expand, develop new products, and enter new markets, which drives their growth. Imagine investing in a tech startup that's developing cutting-edge artificial intelligence software. The company may not be profitable yet, but its technology has the potential to revolutionize various industries. If the company succeeds, its stock price could skyrocket, leading to significant returns for early investors. Growth investors look for high earnings growth, strong sales, and increasing profit margins. It's important to look at revenue growth rates, profit margins, and return on equity, ROE. Companies like Amazon and Tesla are prime examples of growth stocks that have provided massive returns over the years. However, it's important to be mindful of the risks. High growth can come with high volatility. These stocks can be more susceptible to market fluctuations, and if the company's growth slows down or fails to meet expectations, the stock price can drop significantly. Diversification can help manage these risks by spreading your investments across different sectors and industries. Third on our list is dividend investing. This strategy involves buying stocks that pay regular dividends, providing a steady income stream in addition to potential capital gains. It's especially popular among retirees and those looking for passive income. Dividend investing focuses on companies that return a portion of their profits to shareholders in the form of dividends. These payments can be reinvested to buy more shares or used as a regular income stream. Over time, reinvesting dividends can significantly boost your total returns. Companies like Johnson & Johnson and Procter & Gamble have a long history of paying and increasing dividends. By investing in such companies, you receive regular payments, which can be reinvested to buy more shares or used as income. Key factors to consider include the dividend yield, dividend payout ratio, and the company's dividend history. The dividend yield is calculated as the annual dividends paid by a company divided by its current stock price. The The dividend payout ratio shows what percentage of earnings a company pays out as dividends. A lower ratio can indicate that the dividend is sustainable. Lastly, look at the company's dividend history to see if it has consistently paid and increased dividends over time. Consistent, reliable dividends can significantly enhance your returns over time. Companies with a strong track record of paying dividends tend to be stable and financially healthy, providing an added layer of security for investors. Fourth is real estate investing. This strategy involves purchasing properties to generate rental income or to sell at a higher price in the future. Real estate can provide both steady cash flow and potential appreciation. Real estate investing can take various forms, including residential, commercial, and industrial properties. Each type has its own risks and rewards, and the best choice depends on your financial goals and risk tolerance. Imagine buying a rental property in a growing neighborhood. The property can generate monthly rental income, providing a steady cash flow. Over time, as the area develops and property values increase, you could sell the property for a substantial profit. Important considerations include location, property condition, and market trends. The location is crucial because it affects both the rental income and the property's appreciation potential. Conduct a thorough market analysis to understand the area's demographics, job market, and future development plans. Real estate can diversify your investment portfolio and provide a hedge against market volatility. However, it requires more active management than stocks and bonds, and there are significant upfront costs and ongoing expenses to consider. Websites like Zillow, Redfin, and local real estate agencies can provide valuable insights and property listings. Finally, we have index fund investing. This strategy involves investing in funds that track a market index, like the S&P 500. It's a passive investment approach that offers broad market exposure and low fees. Index funds are designed to replicate the performance of a specific index by holding all or a representative sample of the stocks in that index. This diversification reduces risk and provides consistent returns over the long term. By investing in an S&P 500 index fund, you own a small piece of 500 of the largest companies in the U.S. This diversification reduces risk and historically has provided solid returns over the long term. Advantages include low management fees, diversification, and consistent performance. Index funds are ideal for investors who want a hands-off approach while still achieving market returns. They're particularly suitable for retirement accounts, such as IRAs and 401(k)s, where low fees and long-term growth are critical. Websites like Vanguard, Fidelity, and Schwab offer a variety of index funds with low expense ratios. Look for funds with a long track record and low fees to maximize your returns. To wrap up, let's recap the top 5 investment strategies for long-term wealth: value investing, growth investing, dividend investing, real estate investing, and index fund investing. Each has its own benefits and risks, and the best strategy for you depends on your financial goals and risk tolerance. Remember, successful investing is about patience, research, and staying the course. If you found this video helpful, please give it a thumbs up and subscribe to InvestIQ Network for more investment tips and strategies. Leave a comment below with your favorite investment strategy or any questions you have. Thanks for watching, and happy investing!